Hi, and welcome to this first video on my new channel. This is a new channel where I want to talk about interesting investment opportunities. I want to talk about hidden gems. I want to find some ideas to where to put your money in, undervalued ideas, ideas that are out of the spotlight, out of the focus of the public, of the internet, of influencers and the market. So I've been debating myself for a long time if I should do this, but in the end, now I'm really doing this because I personally see this need for myself. So maybe you can understand, maybe you feel the same way that when you go online and you try to inform yourself about investing and to get new ideas and to find interesting stocks or opportunities, um, very quickly you always end up with the same information, with the same ideas. So there are some influencers out there and there are some interesting channels out there, and but I have the feeling, or most of the time they end up in the same kind of ideas. So of course all the mainstream media, they always push the same, the popular stocks, the stocks that have been up, the Magnificent Seven stocks, the Googles, the Amazons, the Metas. And then if you go a little bit more into the deep waters, you get those that give you the secret ideas, or the anti-cyclical ideas, or the growth ideas. But this always end up pretty quickly the same ideas as well. It's the Palantirs, the Teslas, the Nvidias, and yeah, always the same ideas. And then maybe you go into the value channels, and they give you the same ideas. They give you the AT&Ts, the 3Ms, the stocks with the high dividend yield, or dividend aristocrats. But it's always the same stocks. And if you ever thought about investing just a little bit, it becomes pretty clear that the worst thing you can do is invest in things that are already on everybody's mind, where everybody's talking about it, everybody's looking about it, Wall Street is covering them, YouTube influencers are covering them. The idea is to find stocks that are out of favor with the public, that nobody considers right now, that people have just forgotten. And these are the stocks that you can find, or the asset classes that you can find and invest in and ultimately profit from. And this is what I'm trying to do here. Not so much, I don't propose that I have the secret idea to find the perfect stocks, or the next multi-trillion dollar investment opportunity. But I'm trying to find, okay, what could be opportunities that are out of favor with the public right now that could have some growth potential. And I'm also doing this, of course, for selfish reason, because what I hope to generate is kind of a new discourse, which I'm not seeing currently online, of truly opportunities that are under the radar right now and out of favor. So I really value feedback and insights to get from you. What could I be missing, or what could be under different opportunities that I'm missing. And the first really opportunity that I would like to talk to you about today is a company called Snap. Snap. It's not like, maybe you were expecting, you've probably already seen it from the thumbnail of the video, but I'm not saying that I will find this mysterious little companies that just IPO'd that nobody ever heard about. I mean, of course, maybe I will cover those in the future as well. Like, this can be an interesting opportunity. I have a really cool IPO that just came out, and that I'm expecting to really go up. But even more than that, I'm trying to find companies that are out of the favor right now, that are not cool right now, and that could have a lot of growth potential in terms of market cap and market value. So Snap, of course, everybody has heard of this company before, unless you've lived under a rock. They're a social media company. All the millennials probably know them as the app that, yeah, allowed you to take dick pics or nude selfies. And they really, yeah, were the first social media app that pushed that one-time feature where you have deleting content. Um, and yeah, they're very big with the Gen Z. So this is a key topic that I will talk about later as well. Not so much with millennials or older generations. They don't really get what's going on there. But yeah, Snap, a very innovative company. They have their app, of course, Snapchat, but they also do their spectacles. And yeah, I think I've always liked what they're doing, even though I'm not one of the core user groups because I'm a millennial, so I'm a little bit older and I don't really use it myself. But I've been watching what they're doing. I think they do a lot of similar things that Meta does, so social media and metaverse, augmented reality stuff, online storytelling. But I think they do a lot of it better, to be honest. Like, um, as I said, they really they created this new interface that we've seen now with TikTok, where you have one main screen and the UI elements on the main screen as a camera lens. Really, with the acquisition of the Bitmoji companies, they really put this in-app storytelling on a new level where you really can have interactions with your avatars. And I think they just look good. Like the avatars that they have, they look way, way, way better than, for example, the avatars you have on Meta, which look terrible in my opinion. Um, and the spectacles, yeah, not so much. They look a little bit clanky, and the augmented reality, there are probably other companies that are better than them. But I think they do a lot of things very well. And as I said, one of the best things they do is focus on Gen Z. And why is it an interesting opportunity? Because look at this stock price. This is what I'm interested in. Look at the stock price. So this is a company which has basically done nothing for the past 3 years. It's pretty much, yeah, that's what I'm looking for. It's forgotten, it's out of favor. It used to be very, wow, okay, in 2021, this is the next big thing. Everybody was looking, especially with this comparison with Meta, everybody was looking at those growth rates at Meta. Meta, of course, one of the most profitable companies, I think even the most profitable companies in terms of expenditure in the history of the world. And they were thinking about, okay, Snap is doing something similar. They can achieve something similar. And then, of course, a little bit of the reality set in, and people realized, okay, it's not the same kind of profit generation engine that Meta is. And pretty much, yeah, the public, Wall Street, the internet, everybody, yeah, pretty much lost interest in the company. And yeah, you've seen it got pretty low here in 2024, and now again with the recent tech sell-offs, Snap also got sold off heavily, and we've seen it pretty low again here now, sitting close to the 52-week low of 829. So yeah, it's never been as cheap as it is right now, and that's interesting. But cheap doesn't really mean it's a good investment. So let's look at the actual financials. Let's look at the quarterly report of Snap to look at the numbers to see, okay, what's going on here. And yeah, just looking at the highlights here, just to get a first impression here of the quarterly results. We see, okay, revenue 1 billion, 1.5 billion is up. Okay, it's up 14% year over year. It's pretty good, to be honest. 14% year over year revenue growth is good. Then the second number here that we have is revenue per user, 344 to 329. It's also up. That's what you love to see, right? Of a company, because getting new users is difficult. So yeah, just increasing the revenue per user, it's incredible. It's great. You love to see it. And margins going up as well is also good. And then, of course, we have here something which I think is the most important thing. You have here net income was 9 million compared to a net loss of 248 million per year. So the company is actually making income right now. It's not huge, and I wouldn't really call them profitable because of other reasons we're going into right later, but they actually have a net income right now. Which, okay, isn't net income the purpose of a company? Of course it is, But everybody that's ever thought about tech investments, you know that it's very common for technology companies to actually operate on a loss for a very long time. Some companies never make a profit. I mean, I think Spotify, for example, only very recently turned a profit. And yeah, for Snap, I think it's not that much of a problem because, as I said, they're with Generation C. That's the main investment thesis here. That they're with Generation Z, and yeah, everybody knows Generation Z is they're still young, so they're 14 to 26-year-olds right now, I think, and they haven't even gotten close to reaching the peak earnings potential. So you can't have a company that focus on Generation Z um, really expect to making this much money at the moment. But already seeing net income of 9 million is great. And here, look at the earnings before taxes, before taxes and I forgot what EBITDA stands for, but I think before taxes and expenses and deductions. So yeah, also pretty great. From 159 million up to 276 million is a great number. It's a great number. So cash flow increased as well, 231 million. Free cash flow increased as well to 182 million. So free cash flow, of course, is always a metric. It's very interesting for value investors. Yeah, overall, I think it's just here looking at the quarterly results. This is a great, already just a great contrast to what we're seeing here. So here we're seeing a company that's like, oh my God, the house is burning down. What is going on? Let's sell everything. Let's close shop. And then we look at their actual. We look at the actual snapshot here of the quarterly results. So what they're actually reporting, and already is telling me, okay, this doesn't look that terrible. It actually looks good. And then just also looking at the snapshot of the business highlights. So they have daily active users, which of course for a social media app is very important. An increase of 9% per year, 39 million. This is great. This is great. Daily active users, 453 million. So of course it's globally, but this is almost the entire population of the United States as an active user. If you think about it, that's pretty good. More than 1 billion snaps shared in Q4 is pretty good. 40% year of years in 40% in numbering in creators, which is very important. And then yeah, they're focusing on improving revenue with advertisers. So more than doubling year over year in the responses, and 30% increase in delivering partnerships with sponsors, and 131% year over year increase in sponsorship revenue, which is great. It's great, but to be honest, for me, this is not as important right now. I mean, it's good to see, but as I said, if you think about the investment thesis, you want them to really be profitable, I would say in 5-10 years, when Gen Z is really hitting earning maximum potential. And then they have, of course, new interesting things going on. So they're working with AI, like everybody. They're working with machine learning. They're improving their augmented reality, and they're improving their in-app storytelling. So I think they're doing a lot of interesting things. As I said, similar to what Meta are doing, but I think a lot of it is cooler what they're doing. But yeah, it's a company that's currently evolving, and I think they have a good sense of what the industry trends are. So as I said, daily active users, 9%, pretty good, pretty good. North America, minus 1%, I don't like to see it. And rest of the world, 70%. So they are really popular in the Asia Pacific region, they're really popular in Australia and New Zealand. But 4% in Europe is good as well. And one thing I think Snapchat for me is there's this whole thing with TikTok going on. I think if TikTok really gets somewhat restricted by government regulation, I think Snapchat really has a potential to be one of the peak profiteers here, because TikTok is more Gen Z. And Gen Z, of course, if TikTok really gets restricted and more banned, people will go to meta products like Instagram, Threads, whatsoever. But I think just from a generational perspective, Snap really is predestined to profit here. I'm not really expecting it to happen, but it could be a potential upset for the company. And revenue, yeah, going up in all of the regions, especially rest of the world. I think it's the oceanic regions. But as I said, I mean, not that much important for me at the moment. And margins are improving, which is also pretty good. Let's look at what we have here. I want to look at, so this is just to look at the income and look at the earnings and the losses. So we really clearly see the trend here. Third quarter of 23, they had 368 millions in losses, and now we have 9 million in profit. So really we're seeing here a trend, we're seeing here earnings going up. It's a very positive story, and again, a story that doesn't fit with what we see here in this narrative. Okay, the number of shares is important for this company because let's go into what are the reasons why this stock is so I think out of favor. It's for one thing that I think the problem is that they have this stock-based compensations, which Wall Street doesn't like to see. They're basically giving out shareholder value for free. They're just giving a lot of value from the company. So almost 150 millions in stockholder value every year. They're just giving out to employees and investors, just basically giving it away as salaries. It's the same as you would have paying salaries. And this is not good because this is diluting the value of the company. So as a shareholder, if you are a private shareholder and you just see them handing out company shares to their employees or their first-time investors, you don't like it because it's diluting the value that you hold. So this is something that's creating, I think, in a stock oftentimes a downward dynamic. But if we look at the trend here, we see that the values outstanding, so the total value, total number of shares out there, is only slowly going up. So it's not that bad. So 1,691 million shares. It's an increase from the third quarter of 23, if we look at it here. But it's not as bad. And if we look at the stock-based share-based compensation here, it's actually going down here. So we see a trend here going down, and I really like to see that. So in an ideal world, I would like to be this number here in this gray area to be 0. I don't want them to just hand out stocks and diluting the value for the shareholder. As we talked about, free cash flow is going up, so it's always great. But I'm not a value investor per se, so I wouldn't say it's the most important metric. And then it's an important thing here with the this on the right side here, the outstanding convertible notes. So it looks like an unimportant chart, but it's actually pretty important. So this is the problem because they have a lot of debt. These are the bonds that they have to pay back, and so we see, okay, in 2025 it's not that much. It's only 36 millions that they have to pay back, but then we see here in 2027 it's actually over $1 billion that they will have to pay back, and in 2028 we have 1.5 billion that they will have to pay back. So yeah, this is a lot of debt, but it's also not that bad. I mean, it's a tech company, and if we look at other so there's a total debt of 3.6 billion, and if we look at other tech companies, so for example, let's look at another mobile app, let's look at Tinder, Match. They have in total this is 3.6 billion, and Tinder, they have 3.8 billion in outstanding notes. So yeah, even more. Or another company, like one of the most hyped tech companies right now, AppLovin. Really one of the companies that skyrocketed in the recent AI trend excitement. They have almost 3.6 billion as well. So yeah, it's not crazy out online. It's high, it's a problem though. But yeah, um, this is one of the reasons. You have to be realistic here. This is one of the reasons. So we could also jump into the actual annual report. So what I've just looked was the quarterly report. But if we look at the annual report, then we see here the okay, what we want to look at. We want to look at, first of all, the debt. So the debt is, let's look at where the debt is. Yeah, okay, here's the debt, the liabilities and stockholder equity. So we see here what we saw before in the chart. So they have 3.6 billion US dollars here in outstanding debt, which is not great, and even if you add it up with other liabilities like leases and I don't know, it could be stuff like insurance, it even goes up to 5.4 billion in debt. So this is not great, but as I said, it's also not that bad, especially if you're considering that their revenue is going up and they actually made revenue. And yeah, what I've seen before here, what this is something that I would like some input for you, if you could give me some input here, because I'm looking for some reasons. So here they're reporting for 2024. They're actually reporting a loss. But yeah, as we've seen in the fourth quarter, they actually made a profit. So what, like, is your opinion that this is a one-time effect? So what I'm expecting is in the annual report for 2025, we will actually see a net profit for the first time. So because we've already seen in the quarterly report for the fourth quarter, we've seen a revenue, a net profit. So here we still see a net loss, which of course is not great if you're an investor in a company, but I'm pretty convinced. Of course, nobody can predict the future, but just looking at the trend, looking at the chart we've looked at, in 2025, we will see a profit here in the annual report. And yeah, I think this could be really a turnaround also for Wall Street and investors, and also for all the algorithms. They see a revenue, then yeah, I think the story could really change and really going up. And yeah, let's have a lot of look at, because yeah, we looked at what are the the issues. So the three issues: the debt, the net loss, and the stock-based dilutions. I think these are the reasons that why the company is going, why the stock price is so undervalued. But all of these trends, in my opinion, are showing in the correct directions. So here, what I was talking about, the stock-based compensation. We saw that in 2022 it was um, in thousands. So okay, I think yeah, over a billion in stock-based compensation. Not great, not great. 1.3 billion. It's still over a billion now, but it's 300 million less. So we're seeing the stock-based compensation is going down, and it's really what we need to see. We need to see the debt going down, and we need to see the stock-based compensation going down. I'm not too crazy about revenue going up. I think it will be good for Wall Street and the public opinion of the stock. But what I want to see is stock-based compensation going down, and I want to see the debt going down. Both of these things are happening. Of course, they need to see happen faster. So yeah, I think this gives an interesting insight into the company. Um, and just just to summarize my case, I'm not saying that Snap, going back at the chart, is, oh wow, this is like a sure thing, this will make you rich. I'm not saying that. I'm saying this is a potential interesting opportunities, and this is what I'm looking for. I want to look at stocks that are completely out of favor right now, which could be interesting opportunities. So, and this could be one. So clearly this stock is out of favor. Like nobody cares about it, nobody talks about it. But I think we looked at the earnings and we've seen the trends are going in the right direction. So for me, this is an interesting case. And yeah, I will look at more examples like this in the future. I will look at more of stocks like this that I just have been forgotten but could be potentially a good investment case. But yeah, would be interesting to hear your feedback. What do you think about this? And yeah, see you next time.